Hey there, awesome accounting student. Mark Franke here. This video is for Accounting 101, Chapter 8 on long-term assets. These are trucks and equipment and buildings and furniture and things that we hold and use for longer periods of time. The test is 1 year, but most assets that fit into a plant asset category are multiple years. So one of the keys to this is we start depreciating an asset that we buy when it is placed in service. Placed in service means that it is being used for what it was intended. So if we have to have any modifications done, if we have to hire engineers or electricians or carpenters or whoever it is that we have to do to get this asset to be placed in service, then we capture all of those costs and we put it in as a cost and we start depreciating it out. So sometimes we might buy a group of assets in a bulk purchase where we get some trucks, we get some equipment, we get maybe even a building or whatever. We have to then get an appraisal of each one of the items and allocate the cost based on relative market value. We'll have another video where I'll walk through how that works, but this is just a basic video on depreciation methods. And we're going to talk about three, one of which you've already done in Accounting 100 and in some cases back in previous chapters. But the first and foremost depreciation method is the straight line method. This is 95% of the assets that are depreciated in the business world are done on a straight line basis. Next, we have a units of production, whether it's based on mileage, if we're talking about a vehicle, or it might be based on the number of units, or it might be based on machine hours, or some other method for figuring out how much production we got from this particular asset. And so we will allocate the depreciation expense based on that. And the third method that we'll learn is the declining balance method. This method is not used really much for financial statement purposes, but it is allowed by the IRS. So that's why we include it in this chapter. It's a declining balance method is similar to what the IRS calls makers, which allows you to depreciate assets, long-term assets, quicker and therefore take a bigger deduction and save tax. So this is problem 8-2B. 8-2B is in your book on page 334 in your textbook. And I've built a spreadsheet that's kind of a skeleton because I'm going to demonstrate some things that we can do to make it look nice. So let's start with the straight line method. I'm going to do the straight line method here, and then I'm going to use this as a template to calculate the units of production and the double declining balance method. So our cost of our truck in this case is $324,000, and I've made a data section that is a very common thing to do. We have a data section over here, and that way we could use this for other depreciation calculations. So we've got the cost is $324,000. Our estimated salvage value is $30,000. It's an estimate. We don't know exactly how much this machine is going to be worth at the end of our 5-year period, but we estimate it to be $30,000. And our useful life in years is 5 years. So if we divide the total depreciation, which is the depreciation we're going to have expense over that 5-year period, and so it's $58,800 per year. I've got a little bit of a formatting issue there, so I'm going to put the comma with 0 decimal points, and then is 58,800. So our beginning book value is the cost. That's what we recorded this asset as. And then every year we're going to take 58,800 as depreciation expense. In the straight line method, it's exactly the same. So at the end of year 1, the accumulated depreciation will be 58,800. Year 2, 117,600. Year 3, 200, and at the end we'll have the 294 total depreciation that we anticipated. So book value means the cost minus the accumulated depreciation. The original cost was 324. The accumulated depreciation at the end of year 1 is 58,800, so that's a book value of 265,200. At the end of year 2, it's 206,400. At the end of year 3, it's 147,600. At the end of year 4, it's 88,800. And at the end of year 5, we should have the $30,000 estimated salvage value that we anticipated. And so it works, and that's where we are. So we're going to be making journal entries every year, 58,800. Probably spread each month to depreciate this asset. So now let's copy. I'm going to highlight this, Control C to copy, and I'm going to paste it, Control V to paste, and I'm going to build this second calculation for the units of production method. And I'm going to clear out all of my cells so that I don't have any bad data in here. I'll just go ahead and clear it out. We'll build it from scratch. Again, our beginning cost is 324. I'll go ahead and plug that in. The cost of the truck is also 324. Our estimated salvage value is 30,000, and I want to put that in as a negative amount because I'm going to subtract it to get our total depreciation of 294. This is exactly the same process we did with the straight line method, but now instead of useful life in years, we're going to do useful life in units produced. So we're going to use the number of units, which is 1,470,000, as the amount that we will, the life of this machine is going to be 1,470,000 units. How did we get that? It's an estimate. Might have gotten it from the manufacturer or somehow. So if I now divide the depreciation of 294 by the number of units of 1,470,000, I'm going to get a number that is less than 1. So I'm going to add some decimal points, and it's basically 20 cents per unit. This is the depreciation per unit. So now I'm going to multiply the units produced for each year times the 20 cents we calculated as the per unit amount. So the first year is 71,120. Second year is 64,080. And I'm going to pause the video, and you can do the calculations, and I'll be right back. Okay, if you did these calculations, here's the numbers you should have gotten. And I'm going to build the accumulated depreciation by just taking each year's depreciation and adding it up to the previous year, and I can do the same thing with the book value, taking the cost minus the accumulated depreciation. Now, we have an adjustment we have to make in year 5 because we have gone over the amount of depreciation that we originally calculated. We said the total depreciation should be 294, but when we're done with these calculations, it's 295,020. So what I have to do is adjust the 5th year depreciation so that all we're taking is the remaining amount, which is 56,680, minus the 30,000 salvage value, because we want that ending salvage value to be 30,000 and the ending book value to be equal to the 30,000 estimated salvage value. All three methods, the book value at the end of the 5-year period should be $30,000. So now let's look at the double declining balance method. I'm going to copy and paste. Control C to copy, Control V to paste. And I'm going to clear this out again. This calculation is going to be a little bit different because when we do the calculation, we don't take into account the salvage value. And this is called the, except at the end, this is called the declining, we'll call it the double declining balance method. The cost of the truck is still $324. Estimated salvage value is still $30,000. But now, and the useful life in years is 5. Which means that our straight line depreciation rate is 100% divided by 5. So I'm going to put the formula in here as 1 divided by the useful life of 5 years. So what that means is 20%, and I'll reformat that, 20% is the straight line rate. In other words, we are taking a depreciation of 20% of the asset every year under the straight line method. But we want double. Double the straight line rate, so we're going to take that and multiply it times 2 to double it, and change that to a percent. So 40% is our double the straight line rate. Straight line rate is 20%, and double that would be 40%. So now, for the first year depreciation expense, I'm going to take the 324 and multiply it times the 40%. So I'm going to be able to take 129,600 in the first year, and that will be accumulated depreciation. So the book value at the end of the first year is 194.4. We have to do this year by year because that declining or book value is what we will use to calculate depreciation for year 2. So I'm going to take the 194,400, multiply it times the 40%, 77,760. I can add that to my previous depreciation to get accumulated depreciation of 207,360, and my book value is now 116,640. So for depreciation in year 3, I'm going to use that 116,640, multiply it times 40%, and then add it to the previous depreciation, and my new book value is 69,984. I will use that to calculate the year 4 depreciation, add it to the accumulated depreciation from the previous year, calculate a new book value of 41,990. And as I said before, I don't want the book value to go below the $30,000 estimated salvage value. So that's why we need to take into account the salvage value. So I'm just going to take the remaining amount, 41,990 minus 30,000, and that means that will put my book value right where it needs to be at 30,000 even. So regardless of the method, we don't ever want to put this below a $30,000 book value, which is equal to the estimated salvage value. So now, in order to make this just look a little nicer, I am going to put a big box around each one of these methods just to make the reader aware that we've got 3 different methods here, and it will make it look nicer on the page. And so I've got the units of production area. I'm just highlighting the area I want to put a box around, and I'm going to the top and choosing under the border tool, the thick outside border. You can find it here. It's thick outside border. And so now I've got a schedule that looks nice. I'm going to highlight, in order to print this, highlight the whole thing, page layout, print area, set print area, and then I'm going to preview it. File, print, and you can see it's on 3 pages, and it looks stupid because it's not all on 1 page. So I'm going to fix that. I get a fair amount of work from students that has this type of thing where it's on multiple pages. You can fix that very easily if you go to the page setup, and I'm going to turn the page sideways to landscape, and I'm going to click this fit 1-to-1 tall, and it's all going to fit on 1 page. Now another thing I'm going to do is I'm going to make the rows a little wider because it's kind of scrunched up at the top of the paper. So I'm going to escape there, and I'm going to highlight all these rows, and I'm just going to make them a little bit wider. I'll take it up to 21. And then, if I go to File, Print, and now it looks better on the page. So I've got one last thing I need to do, and that's put my name in here. And I'm going to show you how to do that using the header. I can do it on the footer, but I'm going to do it on the header. There's the page setup. If I go to Header, and I'm just going to put I'm going to change this to custom. Let's see. Actually, I think there it is. Custom header. I'm just going to put my name in the upper right section. Click OK, and now my name shows up here at the top. Looks nice on the page. I can create my PDF file by going to File, Save As, and then instead of it being an Excel spreadsheet, I'm going to save it as a PDF file. This is so you can submit it, and then when I click Save, it will save it. Okay, that's it for this video. I'll have another one that is based on transactions, what happens when we buy and sell a long-term asset. But that's it for now. Thanks for listening, and I'll see you again soon.